How's it going out there? It's November 23rd. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. It was a shortened weekend with Thanksgiving. I want to change up the format this week. I usually do my monologue today, but I'm going to bring in the one and only Daniel Creech in a second. And tomorrow I have an amazing interview. This person was on my podcast in January, and we got the most downloads. I want to say one of the most downloads in a few years off of that podcast. So actually, I'm going to give it away. It's Kristen Tate. Exciting interview coming up. Just talking about politics, what's going on in the world, what to expect for the upcoming midterm elections. Really great interview. Controversial. Just going to talk about Bitcoin and things like that, which she recommended that she was buying in January, and she's done very good, saying if she liked the theory of Bitcoin. That's going to be a great interview. And then when we look at Thursday's Thanksgiving, no podcast, and then I usually do Frankly Speaking on Friday, and there's going to be no podcast then, giving my staff off and enjoying the time and the weekend with their family. So, just giving you guys a quick update on the schedule, and today I figured I'd bring in my buddy, Daniel Creech. Daniel, what's going on, man?
Frank, how's it going? Happy early Thanksgiving to you and everybody else. I like hearing that staff gets time off. That's this guy, so I always enjoy hearing that. Tell the truth, you're having Frank is a big family guy, as you all know, and wanted to make sure I wasn't going to be alone, so he always invites everybody over. Are you actually cooking? Are you picking up, or what are you doing? You got
the same thing every year.
You got an apron
every year.
Put a good order into either Harris Teeter or Publix.
And it's not even that expensive. Now it's not even going to be expensive even for today's time. It's going to go up a lot. It used to be, I think, like $40. Now it might be like $50, $60. I'm not too sure. But just picking up everything at Publix, and everything's kind of pre-cooked, and you just throw it in the oven, and it's perfect, right? So it's like an hour and a half, everything's ready. And yeah, I usually have everyone over, even the people who are here, my staff. I make sure no one's home alone for Thanksgiving, because we do have some workers that are here without their families. And this year, last year you joined us.
Yep.
Also, another one of our employees, Lars Cusick, joined us. But now everyone's gone. Everyone has their significant other that they're spending time with, I should say, Daniel, right? Which is pretty cool. And you have family coming in as well, right?
Yeah, and I got family coming in, so that'll be fun. They're going to be in town for a few days, so yeah, it'll be a fun. It'll be a Griswold Thanksgiving time of year.
No, that's cool.
Too early for that. We'll joke about the Christmas Vacation, which is the best Christmas movie, but we'll do that.
Yeah.
We'll do that next month.
So, during this time of the year and into December and into the holidays, I feel like investors take a step back, almost like you take a step back with your diet. And for me, I've always lost the most weight in December because it's easier for me to work out. I push harder. Everyone's like, "Oh, I got to gain this weight," and then on January you go on the on your big diet. But when it comes to stocks as well, for me, this is a critical time where I like to look at what's going on next year. I'm attending Consumer Electronics Show, who's positioning themselves perfectly. Rivian, I think, is going to see an incredible bump because they're going to be just the auto shows, and also Consumer Electronics Show. That's going to be first and foremost on everyone's list. The media is going to be there. We're going to be there. You're going to see the new Rivian truck, which is incredible. But I try to position myself because there's a lot going on right now, including going to the holiday season. And Best Boy and Dick's Sporting Goods just reported. And Daniel, as you're seeing, both of these stocks are down significantly after reporting, right?
Yeah. What is? Do you have it live up there? Is Dick's still down 8-ish%?
Yeah, it's 8%, and I think Best Buy is down about 15%. So
now I can hear everybody yelling through their devices right now, because last quarter, when Dick's reported great earnings again, they've been on a run. Just pull up a stock chart of that great company, and they're taking advantage of outdoor sports and doing everything right for the basically they're doing everything right. So you and I were both bullish on it going after reporting last quarter, and we talked about buying stocks at higher prices, how you can always feel like you missed it. Well, here we are again. If we would have bought in that day, the stock then immediately pulled back, then rallied basically back to 52-week highs, only to report and drop down. My thesis hasn't changed, Frank. I'd like to know if yours has, because they reported really good earnings. Remember, everybody, they are comparing to last year's results were phenomenal because of the pull forward they got from the coronavirus. They beat guidance. They raised guidance by about 10% on the low end, meaning if you compare the low end of their guidance to the previous low end of their guidance, they bumped it about 10% for earnings per share for fiscal year 2022. I'm still this is one of those good lessons where I'm giving everybody a little bit of something here, Frank. If you're bullish and you agree with me, then hey, life is still good. The thesis isn't changing. Only the price has. So continue to be patient. That's just part of investing. If you're disagreeing with me, you're saying, yeah, you bought it, you hit the top, it pulled back. Now it's barely getting back and dropping again. So we'll continue to see who's right. Still down on paper, but I still think the thesis isn't changed, and I'm still bullish on that name.
I may disagree with you here. So I'm pulling up a
Nice.
chart if you watch this on YouTube. And when I see Dick's Sporting Goods is up 150% year to date. That matters. Okay, we have to put that in perspective, right? And Best Buy, believe it or not, is only up 30% year to date, which is a lot different. I'm going to bring this up, and I'm doing a comparison now. So let's bring up Best Buy and throw it in here. Because Best Buy isn't really up that much year to date, but it has performed pretty well. So when I look at Best Buy being up and, about a little bit more than the S&P 500, so about 27% compared to 17%. But when I see these numbers, it makes you look at what has the stock done leading up to this point. And Dick's Sporting Goods has gotten the job done. I mean, if you just look at the year chart, it's pretty amazing. But when it comes to Best Buy, two separate reports here. So Best Buy saw a decline in digital sales, which I guess was expected because they did fantastic during the pandemic. And again, we're starting to get, this is called tough comps period, right? This is called tough comps going forward. It means if you had a great year, to beat that year or to beat that quarters year over years is going to get difficult because this time last year is when the vaccine was approved and everything started opening back up. And yes, we had another wave, but the comparisons are going to get tough. Like just like right now, how earnings are exploding. Think a year from now, what companies are going to have to do without the stimulus, without money coming in. It's going to be hard to beat these estimates. So when you look at Best Buy, their sales are flat year over year. They did not significantly raise guidance, which I think the street wanted to see. They were talking about appliance, home theaters, mobile phones, three things that did fantastic, but they said they had constraints in areas like appliances, gaming, mobile phones, right? So if you're having constraints, you're not be able to sell, as many products as you want. They have 50% more inventory year over year, which is good heading into the holiday season. But again, when you're looking at Best Buy and comparing it to what they did last year, I could see, people were expecting a much better report. Dick's, on the other hand, their sales rose 13% year over year. They blew out the earnings. They blew out the $3.19 they generated last quarter compared to $2.02. So 50% plus beat on earnings. They raised guidance significantly. Expects full year sales to be up 25% compared to 20%. But again, the stock's up 150% year to date compared to, 27% for the S&P 500. So where am I going with this, Daniel, is that you have to look at where the stock is and how these stocks have run up tremendously. It was almost guaranteed that no matter what these guys reported, because Dick's blew out the numbers, Best Buy was okay. I would say they didn't meet the whisper numbers. And you're seeing a 15% sell-off in Best Buy, and you're seeing an 8% sell-off in Dick's. But these stocks have run up, considerably. Best Buy, if you're looking since the pandemic, has run up tremendously, right? In the last year to date, not as good, but they were one of the beneficiaries. They were one of the places that were allowed to stay open during the pandemic. They did fantastic, and, their digital sales exploded. But, we have to look at these reopened stocks and see how much they went up and what's going on now and what the future is. And we saw that with Zoom as well, pull back significantly, right? I think that stock was 400. It's around 200 now, a little over 200. But you're seeing a lot of these plays that were great during the pandemic are really starting to pull back a little bit. But Dick's Sporting Goods, look, those numbers are still there. They're still right. I think Dick's is a good buy off of this pullback. I wouldn't say so much Best Buy because they are seeing some constraints. That's just my opinion. I think it's two different situations, but it's amazing that these companies both put earnings and you're seeing a significant drop-off, which, heading into the holiday season, I don't know. I don't really know if it's a buying opportunity for any of these guys. I'm not too sure.
I was going to say, I didn't feel like you were disagreeing with me on Dick's there. I'll go with buy after this report, even though it's been basically flat since the last time we were excited about it.
Yeah, listen.
That's a fun game. I'll buy going forward.
The one thing I like with Dick's is that they did report those good numbers. So they reported amazing numbers. I would wait a little bit before I just decide to buy this thing in the pullback because it's been a buy on pullback market for 10 years, right? And every time we get to this point, every single time we get to this point, all the bears come out and say, you're crazy. Listen, we got overextended. The S&P went up how many days in a row? I think it was like 10, 12 days in a row or something it went up. We got really extended there. And now we're pulling back. You might not know because it's saying the indices, S&P is closing in a record high. But underneath that, when you take out Apple, Microsoft, FANG stocks, Again, we got to think of a different name for FANG because Facebook changed its name to Meta and screwed up everything. But when you take out those stocks, you can see the underlying trends, right? That are worse. But I don't know what the new acronym is going to be anyway. But for Dick's, I would wait here. I would definitely wait. I mean, at least they have that earnings where they blew out that earnings potential. You didn't see that from Best Buy. Best Buy, I would kind of avoid. I want to see another quarter first. Dick's, I think it comes down a little bit more before you're going to see that buying opportunity. But for me, it's just, you're buying a name that's up tremendously with anticipation that this quarter is going to be great. It was. And I'm not too sure if I'm a buyer on this pullback. I just want to see this stock a little bit because it's up tremendously. I just think there's other places to put your money right now. But again, we agree to disagree, or do I agree with you? Huh? Yeah, I think it's...
No, you're on the sidelines. I'm saying go ahead and buy here. You're saying you'd wait. So that's a small
And if you own Dick's, I'm not really saying that you should sell it if you're a long-term holder. But for me, I could see this, just kind of drifting a little bit lower, especially with current market conditions, if that makes sense. But to the bigger point here, Daniel, Dollar Tree, you're seeing that stock move incredibly higher. And I think you are finally going to see a transition where, the big money is transitioned to you start with Macy's and Kohl's and stuff like that. But I put on Twitter of how I paid close to $8 for breakfast. And this wasn't like at a high resort. This was, we're looking for Denny's and there was an hour wait. We're looking for Cracker Barrel, there was an hour wait. We look for Perkins, and there was an hour wait. IHOP, an hour wait. And this is when we went to Orlando just to, spend, a day there, get, for my family, my kids and stuff like that. And this is like a local place. This is a local place where, we, pancakes, French toast, and, omelets for my wife and myself. And, with coffee, and I drink tea, not coffee. But anyway, yeah, to $80, that same breakfast was around $40, $45 a year ago. And I don't know how long this could last, but I could tell you this. It's not just the companies with pricing power, right? Because you're saying they're going to be able to raise prices. They're not going to be able to raise prices forever. But if you're looking at places that you could eat that are cheaper, places like, Dollar Trees where you could shop that is cheaper, I think McDonald's is a great buy here. I think Walmart's an incredible buy here. Dan, you mentioned it when these companies reported, where it was Walmart and also Target, that they got shit from people on CNBC because they said, listen, we're not going to pass off all our costs to consumers, because if we do, we're going to lose a consumer. So they're going to eat some of those costs. And, that was a negative reaction. But I love that, because long term, that's a fantastic strategy. Because if these companies think that they can continue to raise prices, and especially restaurants with labor shortages, and have worse service and removing stuff from their menu, and you're still going to expect people to come there as you raise prices, you're crazy. And that's where we're at right now. And I think you're seeing that in some of these results. But the Dollar Trees, McDonald's, Walmarts, these are places that people are going to start going to a lot more, because they're affordable. It makes sense. And even though they're raising prices, they're not raising by as much as everyone else, where everything's still affordable at these places.
Absolutely. We were joking about this. And again, we are in the newsletter business. We want to entertain. We want to educate and help the individual investor. It's just frustrating because we were talking in the office, and I said, man, I'm finally bullish on Target and Walmart. We got out of Walmart. We bought the same time in Curzio Research Advisory. We still have Target. It's a great winner. It's a great boring stock. But when you see the stocks pull back for what the CEO of both Target and Walmart said, and, they pulled back, 3-5% maybe. We're not being drastic here. We're not putting out headlines and saying the stock's tanking when it's down 3% like a lot of people do. As an investor, when you have the heads of these companies saying, hey, we're not going to gouge people, we're going to help them. We're still going to manage the bottom line. We're still going to focus on profits and rewarding shareholders, but we're going to invest in the things going forward, because you're a grocery store business. You're a services business. Of course, you want long-term customers coming back, and that's how you keep customers and you gain more customers. This is an easy segue, Frank, to who got reappointed the other day? Fed chair. Mm-hmm. So the low-hanging fruit here is nothing is going to change as far as the direction of things that are going. And what direction do I mean? I mean the rich are getting richer, poor are getting poorer. Inflation hurts those at the bottom the most when food prices and things go up. So think if you had 15 to 20% of your wages going towards food, energy, and living, as that continues to increase for the bottom half, there has to be choices being made when people's lives start to get affected. So Dollar Tree, Frank, did you see this stock? It's up over 50% from basically mid-September. Dollar Tree is.
No.
It went from 80 and change to damn near 140.
Wow.
86 to 138. Right now it's up 4%. Mm-hmm. Dollar Tree is great. those are really solid areas, but I'm with you on Walmart and Target and also Amazon. And it's not investing in the right things, your people, logistics for the longer term. It's not a big coincidence that Goldman Sachs, the most wonderful, awful people in the world, picked Amazon as their stock of the year next year.
Oh, do they really? Yeah, I mean, I think Amazon's
maybe one of them. I don't want to exaggerate like crazy, but I believe it's their top pick for 2022.
Oh, yeah,
and it's Amazon.
Yeah,
the smartest guys. Listen to this. The smartest guys on Wall Street are telling everybody to buy Amazon.
Yeah, and nobody.
And just
cares.
like us, nobody's going to listen.
Nobody wants to buy Amazon. They don't. Especially young investors. You tell them to buy Amazon, they'll tell you, "Shut up! I'll never listen to you again." Yeah. Right? They don't care if it goes up. They rather give me a story stock ESG, give me another a crazy name, and that's really what they like, which is funny. But I look at Amazon too, guys. It's not just looking at an earnings report by itself. You have to look at what the stock has done. And, I pulled up a chart showing how Best Buy is, not that far ahead year to date of the S&P 500, yet you've seen a pullback of 15%. But with that said, since October 1st, this stock is up 35% going into this quarter. 35% nice. Wow. Best Buy is up going into this quarter. So now you've seen a pullback and people taking profits. So, again, you have to look at where these stocks were and where they're going, and is a lot of that priced in, right? It's not just like, wow, this company blew out the earnings. How come it's down so much? Well, if it's up 150% year to date or 35% leading into the quarter, I mean, it's almost you can report anything there, and the stock's going to take a little bit of hit. It's going to be a little bit of selling news, which is common. But the more important theme here, I think, overall, when we're looking at earnings and stocks, it's a dangerous environment. There's a lot of stocks that are down 20% plus. And the Russell 2000 has really gotten hit. You're not seeing it by just looking at the major indices of where they're trading, or even the Russell 2000, but the underlying trends and the stocks hitting new 52-week lows. You're seeing the VIX rise above 20. I can't tell you how many stocks I've seen get hit. Snowflake got nailed right out of nowhere after making a nice move. Just so many names that I was like, holy shit, I can't believe how much these are down. Technology names. I don't know if it's Powell and, people believe we're going to see more inflation under Powell, which means if we're going to see higher inflation, it's not as good for technology companies. And people say, well, that's crazy. Why? Why is because they can't really cut. Their margins are already incredibly high. So they don't have the benefit of cutting costs like cyclicals do. Also, when you see lower CapEx spending, that's where these guys make their money, right? CapEx has to do with spending with companies. If it has to do with marketing, you're going to cut your marketing budget, right? If your sales go down, usually your marketing is a percentage of sales. So marketing is going to come down. That's lowering, your CapEx. Lower CapEx, that's less money you're going to spend in marketing when it comes to on Facebook platform, or if you're going to spend on Google. So a lot of these technology companies get hit, and I feel like people don't understand that, but, they're going to get hit more in an inflationary environment because they can't really do anything other than raise prices, but they can't really cut costs as much to get those margins higher, and that's why they get hit. But overall, these trends are pretty crazy right now when you're seeing what's going on with some of these stocks. I've seen a lot get hit, and I just feel like it's misleading because people are probably looking at their portfolios and saying, holy shit, I'm down. But why is the S&P 500 near an all-time high? It's because a lot of the underlying stocks are really, getting nailed. The money's just flowing out of them like nothing on no news, right, Daniel? I mean, earnings season's over. A lot of these companies reported, and you're seeing, holy shit, why is this stock down 15% and nothing's going on? I can't tell you how many emails I get, just, hey, Frank, I own this stock or I own that stock, and why is it down 50? Not even in our portfolio or whatever, but just, I can't tell you how many times I'm seeing that. And it's basically over the past 2 weeks.
Yeah, there's a lot of volatility, and that's going to continue because you can't have excess liquidity without things moving around large percentages. So, and to agree with you on the tech, it has to be, markets are forward looking. So, hey, what about interest rates? They have to go up at some point. You've been saying that, but one day doesn't make a trend. With the reversal in the NASDAQ yesterday or earlier this week, everybody knows that, basically Powell is saying he's going to try and give you every little bit of information to have a soft landing when it comes to inflation and higher prices and things. So maybe the market tries to test him a little bit. We'll see what happens there. But for the high-flying tech, it's interesting to me that Square, PayPal, the payment services are down a lot.
Cloud is down a lot.
I would definitely look at that. I think it's a little early right now, but there's nothing wrong with hiding out in big tech. I mean, you can't buy enough Microsoft, in my opinion. I think that's damn near a 52-week high if it's not. I've been a big fan of Meta for a while. That's not, that kind of tech, but Google and Apple. Apple's at an all-time high. So hide out in the big dogs if you want to play in the space, and you should have exposure to that. There's nothing wrong with that. Those are great companies. So
yeah, that's the safe havens. But you're looking at Rivian down a lot too. Again, when I look at Rivian, and I was doing some research on this, Daniel, and I'm going to spend just a couple minutes on this because I really want to get to very important news about the strategic oil reserves. But when I look at Rivian and do what we set it to 1 million in sales, and it has $100 billion valuation. This thing came out of the gate at 100, went to whatever it was, 175. I don't know. I think it's like 115 today. I think it's short-sighted the way some people look at these. And I could be blamed for this as well. I could be blamed for this, though, because when I look at some of these names, I looked at them in the past, I say you're crazy to buy. And when we go back and we look at what people said in Netflix, like 2002, 3, 4, 5, 6, what people said with Tesla over the last 6, 7 years, Chanos, David Einhorn, biggest fraud, all this stuff, going after these guys. I see it all the time with some of these growth companies, and I just think it's misleading because when you look at Rivian, people say when compared to Ford and GM, that's a joke. They're not even producing yet. Okay, I get it. But I want to try to figure out what I got wrong on Netflix, right? And what I got wrong on Tesla. And what I got wrong is I didn't understand the TAM, the total addressable market. When you look at Netflix back then, how many people hate it and said, it's terrible, it's going to get crushed. Even Netflix, Tesla, all of them. You don't realize when it comes to Netflix that, they were looking at it saying, how could they be as big? They're streaming. How could they be as big as some of the leading cable companies or direct TVs or whatever back then? But now you're looking at everyone in the world going into streaming, trying to catch up. Nobody really gets it outside of Netflix. I mean, they don't. Time Warner's starting to understand that it's about new content and it's about binging. People don't want to just go streaming where they can only watch one thing. They love to binge. They love when that stuff comes out and they can watch all this stuff. Then you look at Tesla and you say, wow, look at this valuation. It's crazy. How can it be bigger than GM? How can it be bigger than Ford? That much bigger and bigger than all the companies together combined as a market cap. Well, you notice how the entire world is trying to play catch up to them, right? Because they have their EV. You see Teslas on the road all the time. Do you see any electric vehicles on the? No. So now they captured a market that the whole world is trying to get into. And if you look at the valuation or look at companies this way, maybe you'd invest in something like this or a Rivian even at these levels, because Rivian right now, supposedly from the people I talk to, smart people in the industry, they have the best technology, batteries. The Rivian truck is absolutely amazing. If you see it, look at videos, it blows out the Ford 150 Lightning. And I have to tell you, when it comes to Ford, Daniel, Ford controlled that market. The largest selling vehicle, the biggest selling vehicle. Now they're only going to be, when it comes to the electric vehicle, producing 10% compared to, the production that it produced when these things are, gas vehicles, right? So, and they don't really have the technology for batteries yet. That's why they're spending $30 billion for it. Again, it's exciting and it's 20. I get it's going higher. But, when I look at Ford and I look at Rivian's truck is a million times better. And now Ford just went from a market it dominates, which is the pickup truck, to now an EV truck, which you're not going to dominate anymore because there's better players in this industry that are going to be selling more trucks than you in this industry, right? So it's something to think about with Rivian, where, it's crazy, 1 million, but the orders are actually, they're piling up like crazy. You have to put $1,000 down for this. I actually looked through this. I put $1,000 down and bought a Rivian. Did I tell you that? I did that yesterday.
No.
You could say you bought it. I put $1,000 just to go through. It's fully refundable.
They're refundable?
The process. But I can imagine how many people going through the process when you see this truck. This truck is absolutely amazing. If you go on YouTube and watch the Rivian R1, it's really incredible.
I'm gonna be rude and interrupt. When you say you see this truck, it's all online though. You didn't go anywhere and look.
No, but I am going to see the Consumer Electronics Show, and hopefully I get the chance to drive it. If I do, I'm going to put it all over YouTube and everything and tell you guys, give you an update. But you see, this truck, which is unbelievable, start shipping in January. It's going to ship before the F-150. And they have the best technology in the space. So it's going to be interesting to see how this plays out. But, just a different way to value companies where, again, right away we're quick to judge and say, holy shit, look at these sales. Yes, it has a massive market to grow into, but the whole entire world is going into EVs, just like the whole entire world is going to streaming. And if you're the number one player in that market, that total addressable market is freaking enormous. Right. So it's just something to think about when it comes to valuation. But I did want to bring that up because I get a lot of questions on Rivian and even Netflix these days. And look at NVIDIA as well. Valuation is insane. Why? Because they're nuts and bolts. They produce the parts for the highest growth industries in the world, whether it's AI, whether it's autonomous vehicles, whether it's EVs, computing, just everything that super fast chips, the best in the world. And these guys are in it, and that's why they deserve that premium. Anyway, I don't want to go that far into it, but valuations are kind of a stretch here, but it might not be a stretch for some of these other companies that people think are absolutely crazy to purchase.
Right, they do. It is difficult, and I'll be honest. I've missed a lot of these high growth ones because you don't want to be focused on just fundamentals, because nothing would ever really, it'd be very difficult to grow anything if you didn't take chances and do things like that. It's just, we were joking earlier, it's not a price to earnings ratio anymore. It's price to expectations. So will these guys be able to execute? NVIDIA is executing. Not to put words in your mouth there, but Rivian, if they start delivering trucks in January like they're supposed to, they have huge backlog orders. I mean, Amazon alone, and you have a tight stockholders. Amazon owns 20%. We talked about that a while ago. Ford owns, I think, 14% off the top of my head. Those, more than likely, those shares aren't going anywhere. You have a smaller float that can help control the price. It's just an execution story. As an investor, if you want to play in that game and play those high growth ones, great. Just know they're going to be volatile. If not, it's not going to ruin your retirement if you miss out on one or anything like that. So I'm on the sidelines with that just because it doesn't interest me, to tell you the truth, in a whole lot. No. I do want to get your review on the truck and all that kind of thing, though. That's pretty funny. No, and I love the fact that you ordered one and put down $1,000 for it.
Yeah. So I'm gonna get one, and we'll see. I really like it, so it looked really cool. But I just want to see the process, how everything worked, and it was pretty cool. You built your own car and everything. It was awesome. So big news too with we're releasing oil from the strategic reserve. President Biden 2-3 weeks ago said that the planet's warming is a threat to the human existence as we know it, right? So that's why he is drastically cutting oil production in the U.S., right, to save the world. While we cut, OPEC is deciding to produce more. So now what do we have? We have massive inflation in energy, prices out of control. You're making our enemies stronger in the Middle East. And now, you have the icing on the cake to combat the inflation that this administration created. You're releasing oil from the strategic oil reserves as if this oil has less CO2 than the oil you cut from our producers or something. But I guess that the threat to human existence, as we know, we can hold off for that for a little while we do this. But there's just so many storylines and so much irony here, even about the amount that they're releasing from the oil reserves, right?
Yeah, we're doing 50 million barrels. This isn't apples to apples, but we were joking about this earlier. Basically the U.S. uses around 20 million a day. So that's a few days worth. The globe uses about 100, give or take, and I'm rounding there. So don't email. Well, email us even if you're pissed. Frank at CurzioResearch.com. But don't hold our feet to the fire on those stats. This is just a Band-Aid. It's a good chess match. I give them credit. I give the administration credit for what they're trying to do because they want a short-term pullback in prices around the holidays, in my opinion, to kind of help that consumer confidence, help polling, help all that kind of things. But when you think of this as a chess match, it was already yesterday, before this announcement, Bloomberg reported that OPEC was saying, hey, they're essentially going to retaliate. So if the big headline here is, hey, look at the deal making done by President Biden, because he convinced through his leadership to get China, India, and I think there's a handful of others that are going to release this to try to, lower the price of oil. In reality, I think the market is looking through that. I think this has been priced in. I think Goldman put out a good note about it's already priced in. Oil is up over 1.5% today. It's damn near 52-week highs, marching towards $80 a barrel. We've been bullish on these names. I recommended ExxonMobil in our Dollar Stock Club. It's not done great, but it's positive now. I just don't. There's no way that this makes me less bullish. It makes me a lot more bullish on energy, especially going into next year, because this is foreshadowing that they're not doing anything about the core problem, which is production and drilling. They're just playing politics with it, and that's a result in higher prices. So I'm going to say this outright, and here come the emails. Okay, so out of all the things I've seen from this administration and what they've done to weaken our country, leaving troops in Afghanistan, right? Illegal immigrants running wild at a 60-year high. I'm not going to say deficits because you could blame that on every single president. So even the infrastructure bill, whatever, I won't even put that on Biden. But defund the police, influencing racism, allowing critical race theory to be taught in our schools while creating a white supremacist theme that doesn't exist. Forget all that shit, Daniel.
meaningless. Having the U.S. no longer be energy independent has the biggest long-term consequences than any of the things that I mentioned. Affordable energy is a requirement. You need it to have strong economic growth. It's no coincidence that the strongest countries in the world, most powerful countries in the world, whether it's U.S., China, Russia, India, Saudi Arabia, Canada, they have the most natural resources. Being the producer of affordable energy, which we are in the U.S., makes us stronger. Other countries will always need us. It allows us to have power, the upper hand to negotiate with other countries for so many different things. Taking that away weakens us. It makes our enemies stronger, which I don't know if you're familiar with other OPEC members, however many there are. What is it? Something like 20 something, I think. I think there's 14. You can correct me on that. But I want you, some of the members in OPEC, I just wanted to tell you, right? Because we're making OPEC stronger. Iran, Iraq, Venezuela, Libya. Not the most friendliest nations. Okay. Now, OPEC's been around for 60 years, where in 1973, we imported 35% of our oil, and we were like back then, holy cow, it's too much. We got to do something about this. By 2010, it surged to 60% we were importing. In 2019, thanks to our new technologies, fracking horizontal drilling that went from 2011, 12, 13, all the way through this decade, we became a net petroleum exporter of oil for the first time ever. And that's going back to 1949 since EIA kept statistics, which is amazing. Now we're about to give that up. But the irony here is we're giving it up because current administration, a lot of people believe that the world is in danger, which is okay. Okay, that's fine if that's what you believe. But now you're releasing oil from the strategic reserves because you created a runaway inflationary environment. Those higher energy prices impacts everyone, every business, every consumer directly. But now you're releasing this as if the world doesn't matter all of a sudden. So for me, the political bullshit needs to stop. What pisses me off the worst, Daniel, is how many funds are behind the Vanguards, BlackRocks, CalPERS. These are the guys that are running our money. And they're using that power to force companies to make stupid decisions for political purposes, like telling our large oil companies that you can't drill. Don't drill. We don't want you to drill. So what's going to happen? We don't have the replacements here. We don't have alternative energy. We don't have the replacements right now. So what's happening? We're seeing massive, massive inflation. These guys aren't drilling. We get, these little idiot guys that take a position on the board that are able to influence these bigger shareholders. And the way to combat this is, if I was these oil companies, I would go private. This way, I love Chick-fil-A. Chick-fil-A's business model, we're private. They get attacked for being a Catholic organization, whether it's from the transgender coup. You know what they tell them? They say, fuck off, we don't care. However, if you're large, well, they don't curse. But if they do say that when they're together. They're like, these guys nuts, whatever. This is our company. We're running it the way we want to. You can't say that if you're a 2% shareholder and the largest shareholders control 30, 40, 50% of your company now, right? Because then they could influence. And now you have the large oil companies in the world being told that they can't drill, which is insane. And now we have runaway inflation. This is the most important point. If we could lower energy prices, inflation will go away. And because this impacts every business, this is one of the reasons why everyone is forced to raise prices, every business, because the energy prices. So the fact that we're even messing with this, that we become energy independent, is just crazy to me, considering that China's communist country, Russia, you're looking at places that don't care about this. And if they're not lowering their stuff, which of course they said they're going to do, but if they're not really lowering their CO2 emissions, which, Beijing is doing it right now because they have to, they got the Olympics a couple months, but they're not going to do it. They're still producing coal like crazy, and you can't blame them because it's energy, it's cheap energy, and they don't really care about the environment. But if our other countries don't care about the environment, and we do, we're making them significantly stronger. And we're losing our edge here. And that's what's crazy. So I understand the pullback. I understand if you think about climate change, but we need something to replace it. You can't just stop drilling oil and say, we're going to stop drilling. Someone else is going to drill it. It's the same CO2 that's hurting the world, right? So let's drill it for now until we have solar, wind, nuclear, all this stuff that we could replace. But if we don't replace it, man, you're going to see $120 oil prices. We're going to see $5 a gallon here, which you're seeing in some places in the U.S., but for me, this just doesn't make sense to me. Again, nothing really does have to make sense. It doesn't matter. Even if you capture shit on video these days, you could still have an opinion and disagree. I could shoot you in the head, Daniel, and I could say, I didn't shoot you in the head. And it's okay. Well, you shot him in the head. No, I didn't. I didn't shoot him in the head. What are you talking about? I did not shoot him in the head. Yeah, you did. Yeah, we saw it on video. It doesn't matter. That's the environment we live in now. Sorry. I can't
That's a good rant. Yeah, it's good energy rant. You took a lot of, that's fun. Hey, but if you agree with us, if you're listening to us, I'll give you two names. Devon Energy, which is an old fan favorite of ours. That stock's been on a tear a lot with oil companies. And Continental Resources, who the chairman, I think he moved to chairman, Harold Hamm. If you can't back a guy that writes damn near $1 billion in a divorce check and has to write it out, I don't know what to tell you. So those two stocks, I think those are, if oil stays here or goes up, Devon's doing a great kind of split shareholder friendly thing. They're doing a minimum dividend and then they're going to scale it up and down depending on oil revenues, which I think is smart. It's going to attract investors' base in my opinion. So yeah, Devon and Continental, if you want to play, if you agree with us on higher energy prices and want to profit, which is what you should do. Don't just be upset about how the world is since you don't make any of the rules and you're stuck to playing it. Profit from it. And those are two names to do it.
And Harold Hamm Continental, just to let you know, I don't know how it's been the last 2 years. I haven't looked at it, but the last 10 before that, 12 years, again, going through the fracking boom. These guys don't hedge, Dan.
He didn't hedge at all.
They don't hedge. Hedge.
I don't want to say at all, I don't care very little. Yeah, that was a big deal.
Very, very little hedging. And I mean, so what does that mean? It means that they're going to be more tied to the rising price of oil than anybody else. Because a lot of people hedge, and, you're hedging, you're locking in profits. It's smart. You're looking at the largest companies with the largest fleets in the world usually hedge. This way they lock in production and lock in price. This way it's easy to figure out CapEx. You know how much you're paying. You're looking at airline companies as well. But if you don't lock it in with airline companies, now you're seeing demand come back. And if you didn't lock in prices at a lower level for maybe 18 months, now look where oil prices are now, and you pay. So a lot of these guys like to lock in. Continental is one of the ones that doesn't really hedge. So if you think oil prices are going higher, this company is going to benefit more than the average oil company, but it will go lower as we saw when oil prices crashed than most other companies. So, Daniel, we got a lot out, talked about a lot of names. I really appreciate coming in. Happy Thanksgiving, you and your family. And thanks. I like doing this segment with you. I definitely want to get this in instead of cutting this one and doing an interview because we have Chris and Tate coming on. But I said, let's cut my monologue, bring Daniel on. Let's have some fun today. And I really appreciate you coming on, buddy.
Yeah, thank you. Always great to be here. Hopefully everybody enjoys it and we can help out. And happy Thanksgiving to everybody. It's great. It's a good time of year, so enjoy it.
Okay, guys, so we do have our, officially launched Big Money Trader. This is our new service from Luke Downey. Really excited. It's doing well. And to me, in this environment, this is the product that makes a lot of sense right now because you're seeing that big money flow in and out of so many different things. And there's a lot of big technology names outside of those FANG names that are getting hit. This has to do with one of the recent recommendations in Luke's newsletter, but this is using, his system, and it's using options as well to limit your risk and also provide maximum returns. But this is an option-based newsletter as well, not 100% option-based, but he goes over all the educational videos and everything. But you're looking at finding the next big winners in this market when it comes to growth, stocks that you usually avoid that go a lot higher because of valuations, like I mentioned, the Tesla, Netflix, and stuff like that. These are stocks that Luke has in his personal portfolio over the years. And these are the stocks he found based on the money flowing into that. And that's what he's doing now. It's a growth-based newsletter. I think growth's going to trump value for a very, very long time, especially since interest rates are going to remain low. This is a fantastic product. I'm very, very happy launching it. It is being offered at a substantial discount just for subscribers. So if you're interested, go to our website at curzioresearch.com. If not, no worries. But this is a fantastic newsletter, and we're getting already great reviews. You're going to see lots of trades in it. Again, this is in beta version for our Curzio One members who get to see this product before everybody else and, just comment on it, how we can make it better before we launch it. So subscribers, it's not, hey, you got one position so far. No, you got 3 different positions in there right now. And already you're going to get to trade a lot of these things. And Luke does a great job explaining those option strategies, how to trade them, again, you can do this through your E-Trade account, your Ameritrade account, whatever, your Schwab accounts, even your Robinhood accounts. But options are so big now. I've never seen so many people trade options. So many people get so many questions on options. This is a great newsletter, especially being option based. And also you're going to see long positions in it as well. So really excited. That's our first back end newsletter we're launching in a long time. It's doing well. I want to say thank you. But that special offer was going to give you a year for free is going to end very, very soon. So if you're going to take advantage soon. If not, once that comes off, then that year, you can only subscribe for 1 year for that price that we're offering at. So guys, that's it for me. Really appreciate all the support. I won't go too much into Thanksgiving right now because I am going to see it tomorrow with a fantastic interview with Chris and Tate. Again, one of the most widely listened to podcasts that we taped this year, which was in January. She's coming back on. She's controversial. It's awesome. So definitely stay tuned tomorrow. And as always, thank you so much for the support. I'll see you in a couple hours. Take care.